Okay, I think we might be on. We might be rocking and rolling this morning. We are just I'm gonna hold on just for a minute or so and make sure everything's working. Technology isn't always your friend, especially first thing in the morning. All right, if you're out there, drop hashtag coffee break into the chat. We'd love to hear from you. If you guys have any questions as we move through, would love to hear any questions that you may have. All right, I think we are ready to go. And welcome to this week's edition of the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. And this week's topic is we're going to be talking about understanding your financial statements. I promise I won't get too accounty. We won't get like too crazy with the terminology, but what I want to do is I want to give you a general understanding of what you want to look at, or so that you know what you're looking at when you do look at your business's financial statements, because it is important. You do want to understand what's going on. You want to know more than just what's in your bank account. You like to know what your financial statements look like. So it's important as a business owner that you at least have general financial literacy, that you generally understand your financial statements, because it will impact your decision making, not only on a business level, but even on a personal level, or if you're looking to bring investors in. So it is important that you do have a general understanding of your financial statements. So your financial statements are a report or multiple reports that are going to show your financial activities, the performance of your business. In many cases, you're going to use it to make decisions. You may be using that information to give to a lender so that they can make a decision as to whether or not you are eligible to borrow money, or you might provide your financial statements to an investor so they can make a determination as to whether or not they would like to invest in your company. And it's really it's a health check of your business and looking at overall what you have earned to date, and then where the earnings potential may lie in the future. Your financial statements are going to cover typically a period of time. Um, we look at clients' financials on a monthly basis. We also look at it on a quarterly basis, an annual basis. So it's really going to be the period of time that you're looking to kind of understand what's going on. There isn't kind of one off, one all. But typically it's either going to be a month or quarter or a year when you're looking at your financial statements. So it's really just going to give you a snapshot of the position that you're in at that moment in time. So how healthy is your company? Can I gain any insights from the overall performance of your company based on your financial statements? Gaining that snapshot of your operations, your cash flow, and so on. So your financials, or understanding your financials, really are an essential part of your business. So what are we talking about when we talk about financial statements? So we're talking about your income statement, your balance sheet, and then a statement of cash flow. So we're going to start with your income statement. What is that? It's also called a profit and loss statement, or a P&L. And that's really going to be your revenue less your expenses equals your profit. Very simple. We're not going to get too talk about cash basis or accrual or anything like that here. It's just simply revenues less expenses, your net profit or loss. So again, we're going to be looking at the overall net income of the business. Now, your balance sheet gives you more of a snapshot of your financial condition at one moment in time. So when we talk about an income statement, we're going to be looking at an income statement that's for a month or a quarter or a year. With your balance sheet, it's going to be at a specific date and time. 12/31, year end, or June 30, quarter end. So that's going to be kind of a slight difference between the two of them. Your income statement is going to run for a period. Your balance sheet is going to be at that moment in time. It's that snapshot that took a picture, and this is where you are at this moment in time. So it's going to show you your assets versus your liabilities, right? And we're going to talk about assets and liabilities in a moment. And it's really, it'll typically is used as a starting point when you're valuing your business. We won't talk too much about that. I just want to talk more about what the actual pieces of the balance sheet are and what kind of story each one of them will tell you as you look at each one. And then the last is going to be your statement of cash flow. And that's going to be, you're changing, that's showing the cash coming in and going out over a period of time. It may not be your actual income. It's showing your cash coming in and your expense or your cash going out, right? So it includes everything. So it's not just revenue and expenses. It's showing the cash flowing in and out of your business. And again, can you afford to pay your short-term bills, pay, this week's payroll, so on. Those are the kinds of things that you would want to look at when you're looking at your statement of cash flow. So let's dig a little bit deeper. Let's talk about the income statement a little bit more. Okay. Revenue. That's going to be your top line, right? This is going to be the revenues that you've earned from your primary activities, whatever that is that you do. Are you in construction? So are you a specialty contractor? So, whatever that you do, if you're a specialty, you're an electrician, you're a plumber, so on, right? What are you realizing as revenues from that primary activity that you have? The next thing are going to be your expenses, right? These are the costs that you're going to continue to have to operate your business, right? So we're talking about, if it's construction, it's going to be all of your costs related to the jobs, all the way down to the operational costs, the cost for the rent, that for the facility that you're in, the insurances that you have, everyday business costs, your operational costs, and that's going to be your expense. So it's revenue less your expense. And then the last thing is going to be your net income. And we hope it's your net income. Sometimes it is a net loss. But again, the goal is that it is net income. And this is going to show you various things about your business. It's going to give you a picture into your overall operations, the efficiency of your management, areas where you might be overspending on your cost, where you could potentially save, and therefore it's kind of eroding at your profits. So where are there possibilities for you to save money? And then overall, kind of the other last thing that we tend to look at too is, are you operating in line with your industry, right? Are you as profitable as your peers? Because you do want to look at where you compare to others, not all the time, but definitely periodically, to see if you are falling in line. Because if you aren't, where are there opportunities for you to make improvements? So the next thing is going to be, we're going to talk about your balance sheet. Now, your income statement was for a period of time. Your balance sheet is going to be this one moment in time. So what's on your balance sheet? It's going to be your assets, right? So your cash, the highly liquid items that you have in your business. So it ends up being cash, and then down to something like inventory or receivables. The inventory and then the receivables are not as liquid as, say, the cash in your bank account. Takes a little bit more to convert those to cash. Down to your fixed assets. So if you're in construction, you're probably going to have trucks or heavy equipment, bulldozers, tractors, those types of things. Again, those are assets to you that take a little bit more for you to liquidate them. So when you're looking at them on your balance sheet, you're seeing the most liquid item at the top working its way down to other items that are liquid. It just takes a little bit more to potentially convert them into cash. Now we have your liabilities. That's you owe somebody something, right? So you have your accounts payable. Those typically will be the items on there that you will convert right away, in the sense that it converts out, the cash leaves. So your payables are typically going to be your vendors, the ones that have 15-day, 30-day, 45-day terms on their expenses. Those are going to be your payables, right? Those are going to be your accounts payable. Down to your more long-term liabilities. You've borrowed a sum of money for a couple of the trucks or the equipment that you have. That is a liability you have on your books, but you're going to be paying that one back over a much longer period of time than, say, your accounts payable, which typically would be, in most cases, is under 60 days. Your liabilities can run upwards of 12 months, but we see in construction in most cases that the liabilities tend to be the more long-term liabilities tied up in the debt related to assets or fixed assets or equipment that the company has purchased. And so, again, your current liabilities are going to be the ones that are due within 1 year. And then your long-term liabilities are ones that have a life or they are due 1 year and after. So again, 1 year and 1 day, after is your long-term, and then current is everything up to that 12 months or that 1 year or the 365 days. And the last is going to be your equity or your net assets. And it really is, it's your assets less your liabilities. And that gets you to your net assets or your equity number. And it's basically, the debt that is technically due to the shareholders, right? So it's similar to your business. Really is similar to your home. You own a home. The house has a value. You probably have a debt on it of some kind of mortgage, and the value of the house less the mortgage is your equity in it. It's very comparable in a business. It's your assets, right? All of your assets, the value of everything, less the liabilities, and that's the equity that you have in your business. And that's really on a very basic level, way to explain it. Just think about that. I use that house analogy a lot. It's the value of the house less the liability, and now you have equity in that property. So now we're going to move on to our statement of cash flow. And the statement of cash flow is going to be over a period of time, and it's going to be broken up into 3 different sections. So the first is going to be your operating activities. The next will be your investing activities. And then the third will be your financing activities. So cash flow from operations is simply going to be the cash flowing in and out from your revenue and your expenses, right? And that's over a period of time. So over a month, over a quarter, over a year. It's the revenue you're generating, the expenses that you're paying, anything else like that comes in and out of the operating activities. The next down will be your investing activities. And that is going to, excuse me, that is going to be cash generated or spent related to the investing that you've made. So for instance, you've purchased an asset, you've purchased a fixed asset, you've purchased a truck, a piece of equipment, right? That all goes on the investing activities because now you've brought that in. You may have borrowed on that, which we'll see in the next section in the financing activities, but you want to show that kind of coming in or potentially going out if you've sold it, but that comes in that investing activity section. And then the last, which we just talked about, is financing activities. So did you borrow money to purchase that piece of equipment? So again, you'd see, an inflow of cash related to the purchase of that asset. And then as you're again paying it off, it's the cash is going out for you to pay that debt down and so on. So it's again showing you the cash flowing in and out of your business related to its operating activities, any investments that you've made, as well as any financing or any borrowing that you've done. So again, you're going to use your financial statements to make decisions, everyday business decisions. Do I buy another piece of equipment? Do I hire another team member? Do I need investors? Do I want investors? What is the overall health of my business? How are we performing? Are we performing optimally? Are there places that we can make improvements so that, our business is healthier, more profitable, and so on? There are a number of ratios that we look at when we look at the financial statement. So we're taking information from that financial statement, and now we're looking at metrics or ratios or KPIs, key performance indicators. Various industries will have different standards. So that's one of the things that we like to look at for clients, at least on an annual basis. Where are they falling with regard to their competition? Or, not just in their direct competition in their area, but say, we find it very helpful to look at region. So if you are on the East Coast of the US, where do you fall within your competition on the East Coast? And then we can also look at it from a total national level too, but we typically like to look at it regionally because what happens on the two coasts can be very different than what happens in the middle of the country. And so the rates that you see on the two coasts versus in the middle could be different. So we try to get as close when we're looking at these types of things with clients. We try to get as close to an apples to apples comparative for our clients. So I like personally to look at regionally to see where our clients fall. So on a high level, a couple that we like to look at: ROI, right? What is ROI? You hear that a lot. That's going to be your return on investment. It's a profitability metric. It really is going to show you how well your investment is performing. Debt to equity is a big one that we look at in construction, because in many cases, construction companies have a lot of heavy equipment and therefore they have borrowed in order to purchase that equipment. So that is a key driver in the construction industry. And that really is going to compare your liabilities to your shareholders' equity, right? Do you have enough to settle those liabilities? Do you have more liabilities than you have equity in your business? If you do, then there, again, you've now have a challenge there that you need to be able to convert that debt over time and get basically close out that debt. Because if you aren't able to turn that debt over, then there, from that perspective, you are running into a challenging business. Basically, if you can't pay your debt, then you have a problem. So debt to equity is a big one that we look at, and especially the banks look at when our clients go out to borrow money for another truck or for another piece of equipment. They're looking to see how much debt that you have overall, and if they are in fact going to be able to be repaid. So that is really a big one. How much do you rely upon that debt to operate your business? Is it too much heavy? Are you too reliant on the debt? And then if you are you going to be able to settle that debt at a later date? Another big one in construction is going to be gross margin, and that is going to be your revenues, and we're going to take away your cost of goods sold or the cost of your service. So that's the cost of your materials or any labor, whether you're outsourcing the labor or it's your internal labor. Those are that's really a big driver in construction. You want to have higher margins. The tighter the margins are in construction, the more challenging it becomes should a project go not out of scope, but a project, if it runs over in some way, if you have less margin to play with, when you have shifts beyond what you had anticipated in your expenses, then there isn't as much play. And so you want to be in situations where you have larger margins on your service or your product or the construction that you're doing. Basically, you want to have more sales dollars, more earnings after the fact, right? So you want to have a higher margin. There are some of the trades that are higher in the margins, others can be tighter. So you have to be mindful. If you're running down at 20% margin, that 20% is what you have left to spend on your operational costs. So you really need to you want to get more gross margin, higher gross margin, so that you have enough to cover your operational expenses, which again, those are the day-to-day expenses that just don't go away. They will keep coming in your business, whether you do one more construction project or not. So there are a number of products that we use with clients. We tend to use KPI products and financial statement products that help us share the financial information with clients in a more graphic format. So we're looking at graphs and charts and, pie graphics so that a client can kind of see where they're falling. Sharing KPIs with clients that are just straight numbers. Honestly, sometimes I look at that and I'm like, So I personally, I like the graphic. I think the graphic is a lot easier for us to work with clients with. So we use a couple different products. We use a product called Live Plan, another one called Fathom. We also use Profit Sense. Each one of those will provide us a graphic format to provide the KPIs to clients, as well as an explanation or a paragraph to kind of give the client something to use when they're when they're reviewing that particular KPI to determine how important or where it kind of falls in the importance for them. So we use a number of electronic or online cloud tools. We recommend, for anyone else, I think it's you need to understand, go to what works for you. So if the graphic works, I say use it because they're in many cases far easier to digest the information in a graphic format than just looking at financial statements. You want to make sure you're doing a regular financial statement analysis. You're looking at it. If you're not looking at it monthly, then you should at least be looking at it quarterly, kind of see where you're falling. I would not wait until year end to look at your financials. So you want to definitely be looking at that on a monthly basis. We share when we are doing accounting for clients, we share financial statements with them on a monthly basis so they can see where they are. But at the least, you need to at least be looking at your financials quarterly. Anything beyond that, really, now you're so far into the history books that it really becomes hard to make decisions because the information really isn't live or real time. As always, I do highly recommend that you work with someone that can support you in this area, whether you have a team member internally that does it for you, whether you use an outsourced company like ours. You want to have someone who speaks that language when you're reviewing your financial statements so that you have someone to talk to about what you're looking at, what each one of them means. Again, it could be an internal team member that you have, or it could be an outsourced company. And as always, we encourage you to ask us any questions. You're welcome to drop them in the chat at any time, and we'll respond to any questions that you may have. So, as I mentioned, we talked about financial statements today. So, what are they? They're going to be your income statement, your balance sheet, and your statement of cash flows. Each one is going to tell a different story, but in the aggregate, the three of them are going to tell an overall story about your business. So, you do want to be looking at all three of them at the least on a quarterly basis, but we do recommend that you look at them on a monthly basis so that you understand where your business is at that moment in time. And then you can continue on, and then you can make decisions based on the financial information that you have in your financial statements. As always, we look forward to seeing you here every Friday. I thank you very much for being with us this week. I hope you have a wonderful weekend, and we'll see you next week on the Construction CPA's Coffee Cafe.